It's time for another Barside Chat, and I'm glad everybody's back to join us. As always, my name is Matt Jakimiak, and I'm the Chief Investment Officer for Maslow Wealth Advisory. And with me is my portfolio manager and really the guy that does all the work on the investment team, Isaac Thompson. Isaac, you ready to have a great conversation today about markets, what happened in 2024, and maybe what's going to happen in 2025?
Yeah, absolutely. I think the big story in 2024 was the Fed and inflation. Inflation has come down below 3%, although getting back to the 2% Fed target has proven to be a little more difficult. So still some work to do, but with inflation coming down as it has, we've seen the Fed start to cut rates. We have 75 basis points thus far. We might get another 25 in December. We'll see. But I think that's really been kind of the big story of 2024. When we look across the ocean, we see a lot of geopolitical conflict, whether that's Russia, Ukraine, Israel, the Middle East, now Syria. And, there were some optimistic moments in 2024, but it's not clear that those situations improved. And I think some things have actually gotten a bit worse. Ultimately, there's really nothing positive about prolonged international conflict. Elections, globally, it was a bad cycle for incumbents. Voters signaled that they wanted a change in their regimes. And what that change ultimately means in terms of policy and how those policies filter down to the market has yet to be seen, but certainly something we'll keep our eye on going forward. Market returns were fairly positive. The equity markets, and we're not quite to the end of the year, but looking like coming in around 20% globally, led by a strong U.S. stock market. Fixed income, 2.5%, 3%. The Fed may yet have some say in their December decision. And then satellites, lagged returns, so a little harder to project, but kind of in that 7 to 10% aggregated return number. So overall, when I think of our portfolio, I'm relatively happy with the performance. We saw a strong performance in public equities, private credit, and hedge funds, and some more muted returns in private equity, public credit, and real assets. And I think it just goes to show the value of diversification, both across asset classes as well as kind of public and private. So overall, I'd say I'm pleased with the portfolio's performance and ability to generate return from a variety of sources. So certainly an eventful 2024, but as we look towards turning the page to 2025, what are some things that you are looking for?
Yeah, obviously we tend not to get into the forecasting game, and we'll talk about that here in a second. But I think what I would like to do is bring people back to kind of the core tenet of what we've always been trying to do here since I started 20 years ago. And essentially what we're trying to do is we're trying to build an all seasons portfolio, one that really is not engineered to be successful in one certain market environment. We want it to have components within the portfolio that will be beneficial during a multitude of market cycles, whether it's inflationary, deflationary, high growth, moderate growth, low growth, whatever it might be. We want that stability, and I think that's what our clients are asking for, things that have stability through a full market cycle. And so with that being said, what are the things that we are looking at that we think are going to be impactful on this portfolio? Well, I think the first thing, and you've already touched on it, is the Fed, right? I mean, there's that old adage on Wall Street, which is don't fight the Fed. And for the past 18 months, the adage would have been, hey, don't fight it because the interest rates are going to go higher because the Fed is increasing rates. And that was very true. And then it wasn't until late this year that they decided they were going to change their policy dramatically. Clearly, we've already seen 75 basis points in terms of cuts. The Fed dot plot, which, again, I think we've talked about that a little bit in this framework before, but the Fed dot plot essentially takes a vote of every single chairperson on the Fed and basically asks them where they think interest rates will be, the Fed fund target rate will be at various points in time, whether it's at the end of the year, at the end of 2025, 26, and beyond. And if we look at that, given that we've already had 75 basis points of cuts through November, it is projected that we could have another 125 basis points of cuts between now and the end of 2025. If that's true, that's going to be very stimulative to, I think, overall markets, whether it's just adding additional liquidity into some of these private markets that went a bit illiquid, or it's forcing dollars that are sitting in cash money markets right now and ultimately will force them out to go and take risk. Okay. Secondly, we don't want to be political here, but I think we would be naive to think that the new administration won't have some impact on financial markets as a whole. And, whether you like him or not, Trump has a lot of specific things that he wants to enact, and who knows how many of those he'll actually be able to do. Some will be pro-growth, some will be anti-growth. Some of those pro-growth things will be extension of tax cuts that he did in his first term, potentially a lot of government regulation coming down, and also just in general cutting of government spending. I think where we could see anti-growth will be the tariffs, right? I mean, a lot of news agencies have been talking about what these tariffs will look like, how significant they'll be. And ultimately, we know that if he throws on a lot of tariffs from all of our trading partners, that ultimately will be impactful, not only because of end consumer, the prices will go higher, but that will be inflationary for folks. And so we just went through an environment where we were trying to fight inflation to an environment where if Trump, really everything he's saying, he puts on a lot of tariffs, could be inflationary as well. So who knows, more to be seen. Again, I think the truth will lie somewhere in the middle in terms of what is actually being able to get done by the president and the incoming president and all of Congress. So we'll see. I think what is clear is that there's definitely a market shift. And so pre the Fed increasing rates, we were at a point where it was called TINA, right? There is no better alternative. And then we had this interest rate increasing cycle, which ultimately got rid of TINA. And now we're at a point where it's like interest rates could go lower, they could stay where they're at. I think we're trying to find this middle ground, almost like this Goldilocks environment where interest rates are at a level where it doesn't create runaway inflation and hyper growth, but also we're trying to find a spot where interest rates are still stimulative to the overall economy, right? We don't want it too high such that it's crushing economic, demand and growth. So I think where we're at right now is that we still see a lot of value in some of our fixed income and fixed income like investments. So traditional fixed income still has a nice yield. You mentioned that it's somewhere up around 2.5% to 3%. I think there's been some fits and starts on the longer end of the yield curve, but ultimately we still have a place where we can generate return. And more excitingly, it's a place that probably will be protective if we do see some volatility in equity markets. I think where I'm more excited is probably in that private lending or direct lending space where we see interest rates that are still high. And potentially, if the Fed looks at the economic growth and the inflationary picture and says, we don't need to cut right now, that could actually be really positive for those strategies, and that we kind of sit in this environment where we're going to be able to clip coupons that are probably really high single digits, pushing into like that 10, 12, 11% range for the next couple of years if the Fed doesn't do anything. To me, that's really interesting. I think on the equity side, boy, I would have never projected that we would be in 20% rates of return on the equity market, given that we've got global conflicts and we've got an election that was going to be extremely polarizing. So again, it goes back to the old adage that really the markets climb a wall of worry, and as these things get solved or we get resolution, the markets get better and they just continue to climb. And so I think we're in that environment. I think where I would say that we do see some caution on our end is that there is this imbalance that has been building over the last 10 years. And it really has been really a tale of one stock market that has done exceptionally well. And it's really the US. And if we look a little bit deeper, it tends to be much more in that large cap and growth space. And again, not to say that we don't want to participate there because we have no idea where markets will go, but that, that's a space where it feels a little bit like what was happening in the late 90s, where you had these stocks that were at very high PEs. And then eventually those will correct itself. And now the correction could be the stock prices going down, or it could be just that, they grow their earnings. and that they start to grow into these valuations that they have. So again, we don't know, but we want to position the portfolio, and we have, by the way that we allocate to equities, that we're less susceptible to those very expensive companies. We want to participate with them, but we don't want to have an overexposure to them. So those are the things that I see on the horizon for 2025.
Got it. A lot of moving pieces. Appreciate the insight. One thing we hear from clients is, okay, that's all very interesting, but what does that mean for the portfolio? Where is the market going to go, and how should we position ourselves for that prediction?
Yes, I think if I had a crystal ball or my magic 8 ball was really accurate, we'd be using it. I think when we think about, essentially what you're asking is, forecasts. Right. This is the time of season where we hand out holiday gifts, and Wall Street sends out all of their forecasts of where they think interest rates and stock prices will be at the end of the next year. And those are fun. But what I would say is, from our perspective, there's very little value that can be really discerned from looking at those. We view it as another mechanism that really is market timing, because it's basically them saying that they know more about the market and they know how to predict what the future is going to be. And so case in point, when you think about like when Goldman Sachs or Morgan Stanley sends out their expectations for where the S&P 500 will be, well, how do they do that? Let's think about the building blocks of that. So essentially, what is being done is those analysts or economists look at what the aggregate earnings on the S&P 500 are going to be for the following year. Okay, that seems pretty basic. All right, well, the first thing I would say is if I'm looking at what people are expecting the S&P 500 to do for the individual companies, and then in aggregate what the S&P 500 will do for earnings, what I would tell you is they're wrong, right? Like, not that I'm trying to be spiteful or mean, but that they are guessing on what they think they can do. And why do I know they're wrong? Well, historically, when we look at what the S&P 500 earnings are at the beginning of any year, and we can do this through Bloomberg, they typically start very high. And then as the year goes on, what happens? Even in the best of years, when the market is absolutely ripping, we see those earnings estimates go down and down. Why? Because they get more information. They know what's actually happening with their companies. The first quarter hits, the second quarter hits. And there's also a lot of human biases that are being expressed, right? I, as a CFO or a CEO, I always want to talk about a rosy picture for what I think my company's going to do. Why? Because I want my stock price to go up. I'm the CEO. I've got a lot of, stock options that are based on that. So inherently, I want to talk my stock up. And the only way to do that is to say that my earnings are going to be this. But in reality, earnings actually start to hit, and they can't fight what the actual data is. And so they have to start to guide down. And so we look at it and we say, it's interesting to look at and it's kind of fun, but in reality, there's not a lot of information that can be gleaned from it. So that's why we look at these forecasts and we say, that's great, but let's move on, because again, our core tenets are to build a portfolio that is all seasons. So we don't make a call on whether the economy is going to go red hot or if it's going to get really cold, because we have positions in the portfolio that will take advantage of both. So we don't have to play that game.
Got it. Great explanation. Well, thank you all for joining us for another Barside Chat. A reminder to send any questions you have to your advisors so we can address them in future conversations. And on behalf of Matt Jakimiak and myself, we'd like to wish you a happy holidays, and thanks for stopping by.